And good morning or afternoon, wherever you're joining us today. My name is Wes Benali, Principal and National Tribal Practice Leader for REDW, serving Indian country out of our Phoenix office. Thank you for joining us today for the first of a series of free webinars that showcase the various service lines we offer here at REDW. As an advisory-led CPA firm, we're excited to showcase the talent at the firm. More importantly, as practitioners working with clients day in and day out, we felt these webinars are important for you. As tribes grow and look to create opportunities for future generations, there's a need for tools to help evaluate opportunities and to minimize risk as much as possible. We understand that each opportunity comes with many different variables. However, as decision makers on this call, or as advisors to decision makers, we felt that the basics for this process are important to merit this webinar. Today, we will have Brian Fulton, our practice leader for business valuation and related services, in addition to Braden McClintock and Rachel Biro, who all serve in that team, to share a quick 25-slide presentation. And then we'll be jumping into some Zoom breakout sections to go over a couple of quick case studies with the intent to drive home the content and provide some explanation on some of the work that's done. Now, once again, we definitely appreciate the time you've taken to share with us today. And now let me turn it over to Brian.
Thanks, Wes. Hello, everyone. I'm Brian Fulton. I'm with REDW's Valuation and Related Financial Services group. I'll be presenting today with my colleagues, Rachel and Braden, as Wes had already introduced. Really quickly, I guess, background about myself. I'm broaching the 30-year mark in my career and primarily just M&A type work, both in private and public accounting. And so today we're going to go over valuation and financial due diligence, how those services help mitigate risk and help you invest with greater confidence. As Wes said, this is going to be interactive. So the presentation is going to be fairly high level. We know there are various degrees of skill sets in the M&A world on this webinar. So we're going to keep things at more of a high level general overview, and then break out into, I believe, 2 or 3 different groups and work through a high level case study that will hopefully hit home what valuation and financial due diligence can do to help improve your next transaction. So starting with, what is an acquisition? An acquisition is an action in which an organization buys all or part of an enterprise. An acquisition can allow an organization to make more money, create employment opportunities, gain access to new markets or new products, or buy out competitors. However, buying an enterprise can take on many different forms and be very confusing. Successfully completing a transaction typically requires a skilled set of team members that can include attorneys, accountants, IT professionals, tax professionals, things like that. But basically at the core of the M&A process are 2 buckets. There's valuation and financial due diligence. When an enterprise goes through a transaction or anticipates or strategically anticipates going through a transaction, they obviously are going into the deal expecting it to succeed. However, the unfortunate fact is that most deals don't succeed and most deals fail. And I think there are studies out there, one being from the Harvard Business Review, that up to 90% of M&A transactions do fail. the three primary reasons on why deals do fail are: one, overpaying, so not getting an accurate valuation and sound financial due diligence, overestimating possible cost savings or synergies, and the third one is the post-merger integration process. So why perform financial due diligence? We'll be going back and forth between financial due diligence and valuation because they do kind of work hand in hand. But why perform financial due diligence? The main reason is, from a buyer's perspective, is that the seller has the information advantage. So sellers are going to present or restate their financials in the best possible light to increase their value. And that's not to say that a seller would inaccurately recast their financials, but sellers might say, identify certain expenses that they would classify as non-recurring. And they might say, well, we had a lawsuit last year and we invested $100,000 in professional fees. And so we're going to add those back to our income or our cash flows because we consider that not part of our everyday operations. But through possibly the financial due diligence process, we may find that these lawsuits are regularly occurring, and that it wouldn't be a one-time lawsuit that happens once every 10 years, but maybe they're happening once every other year, or maybe once a year or so on. So additionally, financial due diligence will help you, it helps tell a story behind the actual numbers, behind the financial statements. It's a second set of eyes that are observed from an independent party. And why that's important, I think, is because usually buyers and sellers have a lot of emotion. People are excited. I don't know if any of our viewers watch the HBO program Succession, but last Sunday's episode had to do with a potential transaction where one company was acquiring another company, and there was so much emotion going on that it basically drove the ultimate process and outcome. So getting an independent person to get involved and take a look at the deal and look at the financials can help rationally decide whether the deal makes sense. It takes emotion out of the equation. One of the questions that we get asked a lot is, if a target that a buyer is looking to potentially purchase has audited financial statements, do you still need to perform financial due diligence? And so this slide, without getting too technical, is yes, audited financial statements and then the process of performing financial due diligence are two different things. Audited financial statements are basically prepared so that you can, you as a possible investor or reader of the financial statements can say, yes, the numbers are accurate. The numbers, meaning the balance sheet, the income statement, the cash flow statement, they're reflective of what happened last year or the last 2 years. The scope that auditors are following are defined by regulations. The primary focus of audited financials is balance sheet. It's a specific point in time, end of fiscal year, where when you compare to financial due diligence is not focusing on the past, but focusing on the future. We do look to the past to determine almost like a window on what might happen to the future. but our focus is on future performance. The scope is not identified by regulators, but rather defined by the client. What is it that you're concerned with? And these financial due diligence engagements are tailored to our clients' specific concerns. We focus on cash flows. We look at monthly financial statements as opposed to annual, and we'll go over that in a little bit. And in terms of materiality, we look at EBITDA, which is an acronym for earnings before interest, taxes, depreciation, and amortization. It's essentially a cash flow metric, because ultimately a buyer is interested in what cash flows are they purchasing and could be distributed to them. We like to explain financial due diligence as having a home inspection when you're purchasing a house. You negotiate a potential purchase price if you're looking to buy a house, and then you have an inspector come in and go through the house and, for instance, say, does the air conditioner need repair, or will it need to be replaced in the near term? And if that's the case, where you say, well, the air conditioning unit will need to be replaced over the next 1 or 2 years, you might go back and renegotiate your purchase price based on these findings. So if I think of financial due diligence in the most simplest sense as having a house inspection before you buy. But something I want to point out here, which I want to emphasize why financial due diligence is so important in even today's market, is what we're seeing is, picture this hypothetical house is located in Florida, on the coast somewhere in Florida, and a hurricane is coming. And so you're looking at buying this house, and you have a home inspector come in, and instead of being concerned on whether the HVAC or the AC unit needs to be repaired, the potential home buyer is concerned, will the house just withstand this storm coming in? And so businesses are going through transactions right now just to say, basically, will this potential target withstand all these market conditions, recession, inflation, COVID, things like that. And so people aren't paying attention to whether the air conditioning needs to be replaced or whatnot. And what we anticipate is that a lot of call it buyer's remorse is going to surface. It is surfacing and is going to continue to surface because people were just buying targets hoping that they'll withstand our current economic environment. Jumping into valuation, as I said, valuation and financial due diligence, they kind of go hand in hand, and in the next slide or two, we're going to tie these two together. But valuation is the process where you establish value of an enterprise or a partial interest in an enterprise, taking into account the quantitative and qualitative factors and the tangible and intangible factors. And boiling down to the most simplest formula, valuation is the earnings or cash flow of an enterprise times some sort of multiple, and that will equal value. And that multiple could be a multiple of cash flow, EBITDA, as we just mentioned, or a multiple of sales. Those are two of the most common types multiples. And depending on what multiple you're at, whether it's 4 or 5, 6, or even 10 or 12, that is dependent on market conditions, on the target's profitability, on its risk, on its growth perspective. So we take into account what the cash flows and what that multiple and what are the risks associated with earning those cash flows going forward, and what type of multiple to apply to those. Two other concepts that I think are just important to note on this slide is value. That term can mean different things to different people, so we often have to define value to whom. Is this us hypothetical buyer of a business? Is it in an investment value, meaning that there's some synergies to be gained? Is it liquidation, where a company is distressed? The other concept that I just want to bring up on this slide is the concept of price. Price and value are two different concepts. Value, as we've kind of shown, is an economic concept, and price is both an economic and non-economic concept. So price is what a buyer is willing to pay for an enterprise, and that can be computed based on economic factors as well as non-economic factors like emotion, which again, we briefly just discussed when I had mentioned the Succession episode last Sunday. When we're determining value for an enterprise, the valuation community or profession recognizes three accepted approaches. One is an asset approach, which is premised on looking at the target's balance sheet and determining its value based on its net asset value, assets minus liabilities. An example would be if an entity held an office building. You would look at what that office building is worth, and if you were assuming the debt on that building less its mortgage, and that's what that entity might be valued at. The second valuation approach is the income approach, which is typically based on projected future cash flows that are discounted back to a present value date. And the third approach is the market approach, which is shown here. And the market approach is premised on the principle that value of an enterprise can be determined based on what an investor would pay for in the capital markets for a similar type investment. And as we mentioned on the prior slide, when we talk about market multiples, we can look at multiples of sales, multiples of cash flow, but there are other multiples that are used. There are multiples of earnings. Earnings are slightly different than cash flows. And there are also multiples of book value. An example of using a multiple of book value is typically for a bank or a financial institution. Those are bought and sold based on their price to book value. So kind of tying now in valuation and financial due diligence in terms of the M&A process, a typical deal starts with developing a strategy. That's something we talked about on the first slide. There are different reasons on why someone might go through an acquisition, whether it's to gain market or product, whether to gain market or a product, whether to increase or generate employment opportunities, buy out a competitor, things like that. And once you develop this strategy, you begin to contact targets. And if you find a target that might fit your parameters, you then ask for quite a bit of information from that target, starting with financial statements and all sorts of qualitative information about their management team, and you evaluate that information and perform a valuation and negotiate a potential purchase price, which is typically drafted in what we call an LOI, or a letter of intent. And then once that letter of intent, which basically says we're interested in purchasing your business for X amount of dollars, is drafted, the letter of intent might say you have 60 or 90 days to now perform your financial due diligence. And the financial due diligence process begins where you're looking to identify any risks or confirm all those assessments you made in your letter of intent. And anything that is found can then go back to the letter of intent and start negotiating. Once that renegotiation period happens, and both parties agree on a price, then you finalize the purchase agreement, you close the deal, and you begin to integrate. One of the, I think, last items here that I wanted to talk about, just at a high level with financial due diligence, is best practices. The process that we do go through is we always start with similar sets of data, no matter the size of the target or the industry of the target. We ask for monthly trial balances, and we start doing our analysis on a monthly basis, looking for trends or abnormalities or things like that. And why it's so important to look at the financial performance of a target on a monthly basis is because their annual financial statements, as we pointed out, is just a specific point in time. And looking at the financial statements month over month, typically over a 36-month period, can give us a pretty good idea about seasonality, trends, finding abnormalities, and really being able to point out specific company and industry issues. Something that we also wanted to mention and point out in this slide is this third bullet point: transparency with sellers. We go into this process very transparent with the seller. We're not looking to try to find something that the seller didn't disclose. We're there to communicate, here's what we need and here's why we need it. And ultimately, we're trying to just understand what a normalized future set of earnings for this target might ultimately be, so that our client, the buyer, has a pretty good idea and can make a more informed decision on whether to go forward with this transaction. Where we look for risks is, we pointed out a few here just to discuss or show, is we look for customer concentration. So even though revenue may be fairly stable, we want to see what clients make up that revenue. And if it's just a few and you have someone that's looking to take over the business, could you lose one or two clients because of the acquisition and have a serious impact into revenue? We look at vendors. Is there a vendor concentration? Could there be supply chain issues? We'll look at products. What products are in the marketplace? Who are the competitors? What geography we're selling those products in? We look for key personnel. What would happen if the acquisition closed and certain key people from the management team weren't going to stick around? Seasonality and volatility. I mentioned that's why we look at monthly financials as opposed to annual financials. And the last slide here is, doing all this work, we focus on primarily the income statement and the balance sheet. So the income statement is to look historically, normalize earnings into cash flows, and try to project what these future cash flows might look like. We focus primarily on revenue, on cost of goods sold, and on labor. Those are usually the three large items. But we spend just as much time looking at the balance sheet, looking for any off-balance sheet items, assets, liabilities, potential lawsuits. We focus heavily on working capital. Working capital, the formula is current assets minus current liabilities, but working capital is essentially like cash. And there are things that a seller might do to reduce the working capital. So at closing, you're not getting essentially what you thought you were getting. I always, when I talk about working capital, I try to find some sort of pizza image, because I think the easiest way to explain working capital, because the analysis sometimes can get complicated, is if you order a pizza for dinner and the pizza is delivered to you and a slice is missing from that pizza, regardless of the fact on whether you would eat it or not, you certainly wouldn't want to pay full price for a full pizza if there's a slice missing. So pausing here, we're going to go over a very high level case study that hopefully ties together financial due diligence and valuation, and then break out into groups. I hope when we break out into groups, whether it's 2 or 3 groups, that we can spend a few minutes and understand each of our participants' level of knowledge or experience in the M&A market, and then maybe just discuss this case study. I stress it's very high level, very general, but just a way to maybe tie in what I've been talking about for 25 minutes. But the case study is a potato chip manufacturer, who we'll call Enterprise A, is contemplating the acquisition of one of its competitors, who we'll call Enterprise B. Enterprise B manufactures potato chips just like Enterprise A, but in a different geographical location. Both Enterprise A and Enterprise B sell their products primarily to grocery store chains. So the letter of intent that was drafted based on a review of a mountain of information was a purchase price of $3 million. And that $3 million was calculated based on what we call trailing 12 months, so looking back 12 months of sales of $3 million. And that multiple, remember the valuation formula, either sales or cash flows time a multiple, is 1x sales. So $3 million in sales over the last 12 months times a multiple of 1 gets us to $3 million purchase price. Working capital targets are most of the time set, not necessarily in the letter of intent, but definitely in the purchase agreement. But for this purpose, we've set in the letter of intent a working capital target of $300,000, which was set based on looking back over 12 or 36 months on how much working capital, which again is like cash, is needed to be left in the business, so can't be taken out or distributed, so that the business continues to run and operate. So in the group breakout, we've been engaged by Enterprise A, the buyer, to perform certain due diligence related to this acquisition. We perform those due diligence procedures and we find 4 things. And just so everybody knows, we usually find a lot of things, not 4. But the 4 things for our breakout groups are, number 1, that the target, who historically has allowed their clients to pay in 60 days, has started collecting their receivables in 30 days. So they've sped up the collections. They've also delayed paying their vendors. So net working capital now which was set at 300,000, the day of closing is calculated at 100,000, so less than our normalized historical working capital level. Finding number 2 is that the target inflated its sales prior to its year end. This is known in the accounting world as channel stuffing, where you can push a lot of product to your clients to inflate your sales, and your clients may not be able to sell that much product, and they have it, and you may negotiate different terms with them, or you may have negotiated, we'll ship you X amount of potato chips every quarter, but you just fulfilled your upcoming quarter with your into your last quarter, so you won't ship them anything coming forward, going forward for the first quarter, but you've inflated your trailing 12-month sales by 250,000. Remember that the purchase price was developed based on a multiple of one-time sales. Finding number 3 was a synergy identified that your primary product here to make potato chips is potatoes, although you're probably buying some salt and oil too, but with the estimated acquisition of Enterprise B, you'll have significant buying power now with your vendor or vendors, and you estimate that you'll be able to negotiate better prices on your potatoes, which might increase your gross margin by 2% going forward, which would increase your gross profit by $600,000. Finding number 4 was that during a lunch break, while you were eating lunch with the target, one of the employees said that Enterprise B's CFO had heart failure last month. You didn't know about this because the CFO is back at work, and the CFO was one of these key people that you would need to retain to keep operations at a stable level. So although this isn't necessarily what we would determine as financial due diligence, this is part of the due diligence process, and these type of conversations and observations are discovered all the time. So those are the 4 observations. Maybe we can break out into groups for a little bit.
Yes, we're going to break into 2 sessions. So we'll have a good representation in each, and Braden will lead one, Rachel will lead the other. Brian, you'll be assigned to one of the groups, and Wes Benally will be in the other. So you'll be able to jump around, and you and Wes can jump back and forth. How does that sound?
Perfect.
All right, it looks like we're all back in the same session.
Great.
Brian,
yeah,
take it away.
Thanks, Carla. So we have about 8 or 9 minutes left. I thought maybe both Braden and Rachel, you could share what was discussed in your respective groups and if there were any questions.
Yeah, Braden, you want to go first?
Yeah, I'll go ahead and start. We had some good discussion. Obviously we covered these different findings that were a result of the due diligence that REDW performed in the hypothetical case study that we were looking at. And one of the big points that came up was obviously if we look at one of these, on their own, it could be negative or it could be positive. But we for example, we looked at the working capital, that looked like something that was going to affect the purchase price because it's not getting the whole pizza that you purchased, as Brian had mentioned, earlier in the presentation. You expect to get a whole pizza when you pay full price for a pizza. If there's a slice missing, in this case, a slice of working capital sounds like it's going to end up being missing. That's going to change how the negotiation ends up playing out. We also looked at the channel stuffing the inflated sales, how that might also affect purchase price when you go back and realize we based this off of a certain sales metric regarding the valuation. And if those sales weren't in fact what they said they were supposed to be, then the negotiation takes a different form when we go back and say, listen, we're going to need a $250,000 discount, or we're going to need a certain percentage discount off of the sales price based on this new information that we have to light. And before I hand it over to Rachel to touch on maybe some of the other findings and some of the other things that her group talked about, we also looked at all the findings as a whole go into the same bucket, and they're considered against each other, which we'll see. I'm sure Rachel will talk about number 3 a little bit, but sometimes these things are discovered and deals fall apart. Like Brian said, 90% of deals fall through either during the negotiation process or during integration. So looking at all of these together, it's not just a one-on-one sort of answer. As you can see, there's a lot of different positives and negatives going on here. But that was something that we touched on. Had real great sharing from our group, and we enjoyed talking about it. And Rachel, I'll go ahead and let you maybe touch on 3 and 4 and tell us a little bit about what your group found out.
Yeah, so our group actually kept the conversation really high level. And I think that's because Wes made some great points of whether positive or negative. Sometimes when you are a tribal enterprise or a tribal organization, your reason for purchasing might be more geared towards the benefits your tribe is receiving. So you might be willing to offset some of the earnings or even a reduction in earnings for a higher purchase price, knowing that you're employing tribal members or you're providing benefits to tribal members beyond what the earnings of the actual business provide. Wes, do you want to chime in on that?
Yeah. There are times, obviously, a lot of us maybe here on the call are, work with numbers, and obviously the numbers make sense. And when they don't make sense, sometimes, the powers that be do influence, obviously, the purchase, because ultimately they're the ones that are going to sign off on whatever the purchase is. And there are times when, dependent upon the tribe, all tribes have different values and different systems of thinking. And so, sometimes there are opportunities that come about that in a sense don't make business sense, but, from the standpoint of providing jobs and opportunities, those type of, purchases are made, that's just one point that, we talked a little bit about. The other was just basically, in addition to that, what's kind of been the trend, right? More recently, for those of you that read up on a lot of this stuff, is, just purchasing assets or investments outside of the reservation, within, obviously reservations are a finite space. So looking outside of it, specifically to gaming, right? We've seen that a lot with purchases of properties on the Strip, outside the states, different parts of the country, and so, having that ability, and I think in those instances, it's not really geared toward more employment for tribal members, but really from a return on investment. One of the things I did bring up was that one thing to really consider, if you don't have in your current investment policy, is to identify, okay, well, what are the metrics that we're shooting for when making these purchases? Sometimes your investment policy can drive what you think about when making these purchases. What type of return on investment should you have when looking at your due diligence process? And if you don't have that, then it's kind of just making things up as you go. It may look good, it may look nice, but if you don't have a metric to measure against, then that's something that you might want to consider and talk to the tribe about. It'd be good to get your investment policy, take a look at it, reevaluate it, and see if you do have, certain return on investment, hurdle rates, that kind of guide your decision-making process. So that from a number standpoint, you're hitting certain markers, based on that policy. But those are just some things we talked about. Thank you.
Thanks, everyone. So, right. So basically going through this process is to assist our clients to make a more informed decision. And so when we go through a due diligence or evaluation, the findings that we present are very typically quantifiable. So we're showing how that ultimately affects cash flows. And when you have more qualitative findings, we ask questions to our client. How might this affect your investment thesis? But basically the three takeaways from these examples that I wanted to communicate was, number one, when you look at findings 1 and 2, we started off this presentation by saying that most M&A transactions do fail, and the number one reason why, or there are 3 reasons why they typically fail, not in a specific hierarchy order, but the first point that we said was possibly overpaying for a transaction. And if you overpay and you're leveraging that transaction, so you're incurring debt to help pay for that purchase of that enterprise, you might fail because the earnings might not be what you thought they are. You overpaid purchase price and you can't service your debt. So findings 1 and 2 kind of help show that, well, we might want to renegotiate that purchase price down because it's not exactly what we were paying for in our eyes. Finding 3 on the synergy, the point I wanted to get across is we do identify synergies in our financial due diligence process. And remember, we're representing the buyer, but the purchase price never goes up. So we could identify a synergy and tell our client, hey, if you do this, you could increase your margins, you could increase cash flows, blah, blah, blah. But you're not going to go tell the seller, oh, based on REDW or whomever is performing the financial due diligence's findings, we're going to give you more money now. So it just helps in the negotiation. But the point I wanted to come across is it's not always negative, but the purchase price is never going to go up from a buyer's perspective based on synergies finding, because you're not going to necessarily share our report or our findings with the seller. And number 3, like when you're looking at finding number 4, it's more qualitative, but how does that finding affect your acquisition strategy, which is what we talked about as step 1 in the due diligence or the M&A process. So it's noon. We finished right on time. The big takeaway that I want to leave everyone with is that M&A transactions are complicated, confusing, especially in this volatile market. They're even more complicated and confusing. And to help hedge and have a successful transaction, it does typically require a skilled team of professionals, meaning IT, tax, accountants, attorneys, valuation, and so on. So the more people that you can help get involved to get the transaction across the goal line, the chances of the transaction succeeding goes up. So that's all I had. That's the presentation today. Thank you, everyone.
Yes, thanks, everyone. I'll be sending you all a copy of the recording and the slides by this time tomorrow. Thanks for joining us.